Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. There's the opening bell. That means it's time to get ready to go here. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill, who is a 20-plus year veteran in the financial market. She's here to help facilitate the conversation. Welcome to all of you, whether you're here for the first time or the 100th time, whether you're here in the live version or the recorded version. We're glad to have you here. I notice a number of the familiar faces and names here in the chat. So go ahead and be part of that conversation. Keep Connie busy. If you're in the recorded version, leave us a comment. You can also follow us on social media. I'm on X, as is Connie, at Ben Watson CS. She's at Connie Hill CS. I'm also on LinkedIn as well, so you can find me under that same handle, at Ben Watson CS. So love to have you be part of that conversation. Some stuff going on today in the market. Certainly the big news, the big topic, not necessarily news, but topic of conversation has been the move that we've seen recently in metals. We'll talk about a little bit of that. We'll also look at the corresponding move, perhaps in the other direction, in dollar futures. We'll take a look at perhaps some Japanese yen movement, as it has been very strong as well. And since we are on the cusp now of an FOMC meeting, we'll take a look at what might go on and happen with not only equity futures, but also interest rate futures as well, as we get into this discussion here this morning. So a couple of quick housekeeping items. Remember that futures options trading involves substantial risk. It is not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to considering trading any futures products. Remember that futures trading requires separate authorization. Also, remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of an advice or recommendation or suggestion or anything else. It's simply for illustrative and educational purposes only. Make sure that as you start to consider trading futures products, you have an understanding of futures margin. I'll show you some resources to be able to help understand that a little bit better. We'll also talk about that because that is one of the topics, especially when we see something moving in a very volatile fashion, like we've seen with precious metals, specifically silver. We'll talk about some of those differences and what happens with things like initial margin and when you see margin increases. Also, remember that when we talk about, and I don't know that we'll do it today, but we may and have in other classes, talk about virtual currency derivatives. There are some unique and specific risks. Those are not legal tender. They are virtual storehouses of value. As such, make sure that you read the NFA and the CFTC customer and investor advisories about those virtual currency products. When we talk about technical analysis, that's simply one way to look at the market. It is not the only way. It is theoretical in nature, as is fundamental analysis, as is probability analysis. But Schwab doesn't recommend the use of technical analysis as the sole means of investment research. Now, one thing that I want to remind everyone of is the fact that we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. This particular paper money version, because you remember I had some problems with my account last week, so I've reset the account. I'm using my live demonstration platform to trade and show these examples today. However, it is a paper money account, I assure you. I don't have $6 billion of buying power in my live account. This is a paper money account. Now, there are some differences between a paper money account and a live trading account when it comes to things like studies on charts and those types of things, and studies in scans. So just be aware of some of those differences. Of course, remember that none of those uses of the Thinkorswim desktop software platform is any kind of a guarantee of future success out there in the real world. Also, we're going to talk a little bit about stop orders here in this discussion. Just that quick reminder that stop orders on a futures contract are different than stop orders on an equity. Stop orders on a futures contract, if it is set as a stop market order, those orders will get worked as an exchange designated limit order within a specific range of prices designated by the exchange, controlled by the exchange, and that's that protection range or protection band. If the price of the underlying instrument moves outside of that range, That order may get rejected. It may not fill. So that's as a means to protect against volatility. So when you issue a stop order, whether it's a buy stop or a sell stop, and that issues a market order, remember that that's going to get worked by the exchange. We'll talk a little bit about that as we get into this discussion. So let's pop over here to the Thinkorswim desktop software platform, take a look at what's going on in the market kind of as a whole as we get started this morning. Taking a look, first of all, at the equity markets, or at least the equity futures markets, that have been relatively strong over the last few days, although we're seeing maybe a little bit of a bearish divergence in a momentum indicator here, like the RSI. So in the S&P 500 futures this morning, a little bit of a move higher in the overnight hours, and then pushing a little bit higher here still. As we start to see that move to the upside. So TMTM, let me get to that question here in just a minute. We'll bring that question up. So kind of put a pin in that for a second here. That's the S&P 500 futures moving a little bit higher. NASDAQ futures, technology heavy futures, also in the green today. Some general upward movement coming up off of that 50-period moving average. RSI a little bit stronger here in technologies. There's some rotation back, especially ahead of some of the major players on an equity basis within the NASDAQ, Meta and others. So there's maybe a little bit more enthusiasm here in this particular case. And then we start to look at the Russell 2000, the small caps. And the small caps previously, over the course of the last few weeks, have been extremely strong. Now have seen a couple of big down days and perhaps pulling back into a little bit of a bull flag type of scenario here. So as we start to see this pull back into this area, now you start to see that little bit of the possibility of a bounce up off of a support level there. So maybe a little bit of a bull flag. RSI kind of falling off a little bit here. So as we start to see that move, maybe giving us a little bit of red candle today. All right. So, okay, good. So we've got some context to TM's question. We'll talk about that because natural gas is on my list here in just a minute. We'll talk a little bit about natural gas and see what that suggests. All right. So now let's pop over here really quickly to our futures grid because I wanted to kind of get right into some of these discussions. So let's pop over here to our futures grid with labels. And if you remember, let me restore these. So left-hand side is my 1-year daily chart with the RSI. Right-hand side in this particular grid is today's candle, or excuse me, today's trading 5-minute candle. So each one of these candles is 5 minutes. And I've also put on here an ADX, the directional indicator built by Wells Wilder. It's a component of things like the parabolic SAR. It's closely related to the RSI. It is generally a trend strength indicator. And the idea behind the ADX as a trend strength indicator is that anytime, regardless of the trend direction, whether it's a bullish trend or a bearish trend, meaning whether or not price is moving higher or moving lower, anytime that ADX indicator is above about the 25 level, and there's some variations in how it's calculated, but anytime it's above about the 25 level, that is an indication of trend strength. And the further above the 25 level it is, regardless of whether price is moving up or down, the stronger that trend is. So now we're well above the 25 level. And we can see price moving here on /6J. I'm going to come back to this example, but that's just happened to be the last one that I was looking at. But you can see where that trend strength is. The ADX is well up above that, and in fact, above the 70 level. So not that means that that's in an extreme necessarily. That's what the RSI is really good at pointing out, are those extreme levels. Because the ADX can stay, if a trend is very strong, the ADX indicator can stay up in that range, especially with a futures contract. If a futures contract is getting pushed in a particular direction, that ADX, because remember Wells Wilder was a commodities futures trader. And so a lot of the indicators that he built, commodity channel index, RSI, parabolic stop and reverse, those were all designed to work on commodity futures contracts when he was trading on the floor of the commodity exchange. So they tend to work nicely. I never will say that there is one best indicator, but these kind of work nicely in conjunction with one another. And it's not a recommendation by any means. Use the indicators you want to use. I'm just kind of giving you an idea of how these indicators kind of work together. So that ADX can stay, if the trend is strong, up above that range quite a bit, and it can stay there for a long time, much like the RSI. But I think it gives us a better indication of trend strength, perhaps, in the short term than the RSI. RSI tends to lag just a little bit. The ADX tends to be a little bit more sensitive to that push in momentum one way or the other in the short term, in the very short term. So Japanese yen pushing above a resistance level, kind of pulling back a little bit now. All right, I want to pivot back over here really quickly to a couple of things that have been moving. The first one I want to take a look at is /SIL, silver. And this is the small contract. So the small contract here, this is the 1,000-ounce contract. If we pop down this grid right here, we click on the symbol entry box and we come over here to futures, you can see here's silver futures. That is the big contract. /SIL is the 1,000-ounce silver contract. And you can see the tick size, tick value, and then the initial margin requirement in each one of those futures products. Now, you see what's gone on and what's happened. So if for some of you that have been with us for a little while and been in this webcast over the course of the last few months or so, as silver has started to really take off, started to really shine. Sorry, I went for the cheap pun. But what's happened with, especially in the /SIL contract, that smaller contract, that initial margin amount, which is, remember, the amount that we put up to initiate a trade, either buy a long or short. The reason that particular contract is there, or that particular amount is there, and what it's doing is we can see that increase. Well, we can't see that. It has to be experiential. That initial margin has gone from about $2,500 per contract to now over $11,000 per contract in initial margin, and yet the speculative pressure continues. So the speculative pressure here, in this case, is one of the reasons it increases volatility, because that volatility increases the exchange may change initial margin. And they do that as a function of that volatility. There's not a set amount. They have, their calculations and proprietary means that they use to calculate what that initial margin should be. We've also seen in the big contract, obviously, futures margin, initial margin going up as well. This was about $10,000 per contract when the run started. As this initial kind of speculative pressure has picked up, the large contract initial margin has gone to now just over $57,000 per contract. That's pretty significant when it comes to that. So TM asks a question: why is the contract, if we come back here, let's pop this back down, and we go to the trade tab for this contract, why do we still have these contracts that are past their delivery date? And the reason that they were past their delivery date, right? One of the reasons why you will see these contracts, you're always going to see the active contract listed, and the Thinkorswim platform is going to flag that active contract. The reason that there are contracts still here, still on those January and February deliverables, is that there are still positions there that maybe haven't been rolled off and taken out. Now, that is perhaps a function of, because remember, this is a physically delivered product or a physically settled contract. So because of that, there may be these may be institutions that are arranging for settlement, those types of things. But what you can see is that there's generally very little volume in these non-active contracts. This one that's 28 days out, there's still some volume trading as some of those positions start to roll off and get adjusted and get settled. But the active contract is always going to be pointed out by the Thinkorswim platform. So our active contract is the March deliverable. You can see that that's where the majority of the volume is existing at this particular point. We can scroll down through this list and you can see that we have contracts all the way out into the January 27 deliverable. And what that means is, because remember, institutions don't just trade the single contract. Many institutions and some retail traders, and we've talked about it in past weeks, may trade calendar spreads, trading the difference between one versus the other. You'll also see that shift in volume and open interest as you get to near the deliverable date of a contract. So this one, the February deliverable, you can start to see that that volume has decreased because most of those contracts are being rolled, either closed or rolled out to whatever the active contract is. So that's the reason why you're seeing that. So EduKitchen asks a question. When we go back to this chart, what are the time frames that I'm looking at? Left-hand side, 1 year daily. Right-hand side, today's time frame, 5 minutes. I'll go ahead and I'll share this grid with you. And again, remember, anytime we share an item, it is not guaranteed as to time or accuracy, nor is it a guarantee of future success or use for that product. It is simply for illustrative and educational purposes only. So I'm going to go ahead and share that real quick so that you've got that. It's also in the description page for this particular webcast. So I'm looking at /SIL here, and we've seen the big run up. I'm just going to go over here to this first longer term chart, and you can see the run up that's happened. So November into December, we really started to see that price accelerate. You can see the candles got a lot bigger. You can start to see that the move to the upside in the last couple of days. If I zoom in here so we can see this beyond my labels, let's see if I can do this, if I can hide drawn items. Yeah, right now. All right. But we had yesterday's candle was a little bit of a shooting star. We see a little bit of a move down and then back up into the open today, and then a rally up, and it's settled a little bit. And so this is oftentimes one of those areas, one of those times where, again, as we're starting to see a bit of a bearish divergence, even though the RSI is moving a little bit higher here, there might be a little bit of profit taking perhaps here. Now, listen, we are ahead of a Fed meeting. There's geopolitical risk afoot. There is institutional and industrial pressure on precious metals, specifically silver. In this particular case, it's seen a pretty significant move to the upside. You can see what's happened to the size of this contract or the notional value of this contract. So the tick size in this particular case, let me grab this real quick so we can just use the pointer so it's a little clearer. Tick size is 0.005, which means that this digit right here is our significant digit. Tick value is $5. So every time that moves, that's $5. Every time this point moves, so from 108 to 107 or 108 to 109, that's $1,000. Take that $1,000 and times it by the 108.52 or whatever it is, that gives you your notional value in the contract. What that means is this function right here, this point value is really kind of the, if you think about it to a certain extent, that's the leverage or the delta that these contracts have. So if we had a large position in, say, for instance, silver mining or some of those other companies that might be associated, solar companies, chip manufacturers, one of the uses for a futures product like this could be to hedge by buying or selling a futures contract and reducing that sensitivity by about 1,000 deltas. That's the nature of this particular contract. So that, or any particular contract, that gives us that leverage component. So we can use it as hedging. We've talked about that before. Now let's pop over here to the right-hand side and see what's going on in the near term. So remember, this is today, 5 minutes. So my thought was, well, I set up two kind of opposing ideas here. The first idea, and in fact, I have this set as a working order. And this working order is just this. It's a buy stop to buy the futures contract if it moves above the resistance level at 113.20. And then sell it if it gets out to the target of yesterday's high, the top of that blow off shooting star candle up around 118, I think was my target to get out, and then to take this off if it goes down below that level. So here's where I put that trade together. We're going to come back to the chart really quickly, and you can see what this trade looked like. So this was my entry, would be a break above this 113.20. That was the resistance level, and it's bounced under it, and it's not triggered since I put that trade together. As a matter of fact, let me do this real quick. I'm going to just show my orders on this chart so that you can see where those are. So there's my order to get in. That's a buy stop. Here's my order to get out if it goes against us. That's that stop, kind of the midpoint of this channel, if you will. And then my target to get out if it does go in my favor is right up here, right about that 118 mark or so. So looking for this trade, if it were to break in that particular direction, to go from here up to here and then take the trade off and then stop it out if it went below that level, right? That's the stop area. And remember, I did this as a buy stop, which is going to get worked as an exchange designated limit order. I did this as a sell stop to get out of the trade, which is going to get worked as an exchange designated limit order. This, however, my target up here was a limit order. So if price does go to that level, it's going to get us out of that trade on that limit price or very close to that limit price, or higher, but not lower. So there is that potential here. But notice what's gone on. Notice what's happened here. Let me kill my annotations. And this is my second thought. And I kind of started to line this out before I put the trade on. My idea was, in this case, if that trade didn't happen, what if it starts to go to the downside, right? What if it now starts to make this move to the downside and it breaks through this level of support that is established here at the 108 level? Then could we trade it in the bearish direction if there is some profit taking? Yeah, so no trade until we're above 118, or excuse me, above 113. In this case, now I'm looking at trading this in a potentially bearish direction. So this trade right here, that trade is, I think, now kind of invalidated. What we could, let me just say this, we could create two branching, one cancels other trades. I could have a trade it to the upside if price goes in that direction and then cancel my downside trade, or trade it in the downside direction if it goes that direction and cancel my upside trade. So we could have those two branching OCO orders. I didn't want to spend a lot of time on branching OCO orders today. I know Connie's done some webcasts on that. We've got some great resources in our webcast library on that. What I'm noticing now is that price is breaking down through this 108 level, which was my entry to the downside, breaking below that level of support. So we're going to look at taking this in a bearish direction, as it seems to be bear flagging here and moving to the downside. So the first thing I need to do, and this is something that is very important. So as Stephen Sondheim wrote in his musical Assassins, attention must be paid. Because if I were to leave this order on and I were to get into the downside order, and then the order would be to blip to the upside, the price would blip to the upside, there is a possibility that both of those orders could fill, right? That we could get into a long position and a short position. We don't want to do that, right? Because that then represents risk in both directions. So what I want to do now is I want to come back over here to my monitor tab, and I want to kill this order. So I'm going to kill my bullish side. I'm going to right click and I'm going to cancel that order. And we're going to get out of that one. That's gone. Now, what we're going to do is we're going to go back to that chart and we're going to build this order to the downside. Now, it's already given me the condition to get into the trade to the downside. So now all I need to do is build this order. So what I'm going to do is I'm going to say, fine, I want to get into this trade. So I'm going to right click and I'm going to buy. I mean, actually, in this case, because remember, we're going to the downside, we're selling this. I'm going to sell custom with OCO bracket. So my order to enter is a sell order. Now, because it's already given us the condition, which was breaking below that E2 level at 108, I don't have to do that as a sell stop. I can do that as a sell limit. And I can say, look, this is the least that I want to be able to sell that for, right? The least that I want to sell that for. So if I say 106.70, it's currently sitting at 107. So I'm okay. That order is likely to fill because it's above my sell limit order. And I'm going to make that a good till canceled. Now, that's a limit order. That's going to get filled theoretically at that price or not filled if it doesn't meet that limit condition. But now what I want to do is I want to sell this, or actually to close this out. If it goes down, I want to buy it back at a limit price. And that limit price that I want to buy this back at, I'm going to call that 103. So 103, and we're going to make that good till canceled. Now, because we're looking at buying that back, when limit says on a buy order, buy it at this price or less, I don't care if this goes way down. If this makes a rapid move to the downside, that's better for me. But I don't need to worry about this being worked as an exchange designated limit order because we're already setting it as a limit order. Now, here's where that challenge comes into play, though. If we say that, all right, we want our stop to be this stop level right here, where it's at 111, I want this to stop out at around 111 if it starts going against me. So I define my theoretical risk in the trade. Now, if I leave this, and I'm going to make that good till canceled, so those are matching time frames. If I leave that as a market order, as a stop market order, that's a buy stop. That's how we exit. That's how potentially we could exit a short position, is on a buy stop. But that buy stop, if I leave it as it is going to get worked as an exchange designated limit order. And there's the possibility that it wouldn't fill. Just like if I had made this a self-designated stop, whoops, not that one, this one. If I'd made this one a self-designated stop limit order and said, look, buy it back, but buy it back somewhere between 111 and let's say 113. So I might set my limit at 113. So buy it back at 111, but don't buy it back if it goes higher than 113. That would be the same thing, not the same amounts, but the same mechanism, if you will, as that exchange designated limit order. I just want to clear, that understanding up here in this discussion. So we're going to leave it at that. So we're going to leave it, instead of letting the exchange do that, we're going to specify our limit order. We're going to say buy it back at 111, but no more than 113. So that if it goes way up, there's the potential that it won't get filled. Could move around that range. Now, we would then be still short the position if it were to move quickly above there and not fill. So that's a possibility. You just have to take that into account here. So again, not a guarantee in terms of what the actual fill price is going to be. So we're going to go ahead and we're going to click on confirm and send here. This is now moved 106.20. 106.70 is our limit. That's so I'm going to have to adjust that a little bit here. Let's make that 106. Let's make our limit price to get into the trade a little bit lower because I want to get into the trade. So let's make it 106.50 and let's see if we can get to that price. 106.50, and we're going to go ahead and we're going to click on, and you notice that because those are linked, all of those other orders changed. So I'm going to come back in here really quick and I'm going to say, all right, I want to get out at 103 and I want to get out at 113 limit, and we're going to make that one 111. Again, it always pays to pay attention to what's going on with your trade, and the way that you can avoid that adjustment is unclicking those chain links. Click on confirm and send, read through the order, make sure that that's what we want it to do. Notice my initial margin, 11,436, and we're going to click on send. Now we are short this contract. And that contract, we're now looking for this price to move to the downside. Stop is triggered here. Stop is limited there at that point. So if it goes above 113, we're going to get out. Yeah. So potentially, RBTech. So here's the thing. So our entry, so our stop here is at 111. Theoretically, if it moves up to that point, 8, 9, 10, 11, so that's what, about 4 points, and 8, 9, 10, 11, so about 5 points to the downside. So we're risking about 4 to make about 5, theoretically, in this case. But we're going in the direction of the trend. So to say, yeah, we're risking up here. If it were to make that move to the upside, and it were to kick us or not fill the order, if we were to move above the 113, then our risk theoretically could be higher than that $4 to the upside. All right, so that's our entry in this downside move, and the expectation is that it may continue to move to the downside. A couple of other positions here that I wanted to take a look at really quickly in this space. Let's take a look at the natural gas contract, because this is one that is a little bit interesting, and to go to the question that that TMTM had. So let's go to let's go to NG first and take a look. I'm going to maximize these cells again. We'll go to the restore those cells, and you can see what natural gas has done. There's been kind of a fundamental shift in terms of natural gas demand, not only for those of you that have been in the frozen north and northeast. You know that things have gotten a lot colder. They've gotten a lot colder out here in the west, where there is great demand for natural gas as well. The other thing that's shifted natural gas is this is also one of the fuels that drives data center power generation, and infrastructure capacity is such that more natural gas generating facilities are coming online, as are more diesel facilities close to some of those data centers to avoid some of those infrastructure bottlenecks. That means that natural gas has to be moved. That adds to the cost, those types of things. But it's made a big run up to the upside. It's starting to pull back a little bit here, starting to see a little bit of profit taking a little bit here, at least this morning. Take a look at natural gas. You can see in the big natural gas contract, the initial margin in this particular case is pretty significant. If we go to the smaller natural gas contract, the /MNG, there it is right there, /MNG, right there, that initial margin is still relatively small and hasn't shifted. What that may be suggesting, you can see that these two trade differently than each other, right? These are two different instruments. So just because natural gas is moving in a particular direction doesn't mean that the small contract is going to move exactly in the same direction. Now, if it doesn't, if there is a disparity in how those two contracts are moving, there's an arbitrage opportunity for institutions and to be fair, retail traders as well. So they typically tend to stay fairly close to one another, but sometimes you will see those disparities. Now we take a look at the natural gas, the mini natural gas contract. Let's maximize that sell. Tick size is 0.001. So this is our significant digit. Tick value is $1. So every time that moves, that's $1. Every time that point moves, 3 to 4, 4 to 3, or 3 to 2, that's $1,000. $1,000 times that gives us our notional value of the contract, or our exposure in that contract. You can see what's happened in this particular contract. It's made that move, pretty significant gap to the downside. It's pretty volatile. I wouldn't be surprised if we were to see the exchanges increase the initial margin in this particular case, right? So taking a look at the trade tab, and we'll take a look at micro natural gas. So here's our active contract. So I think the question initially, I think you were on natural gas, right? /NG. This is an interesting question. Let's take a look at natural gas. So here we have this contract today. This is, and you notice they have this and the micro natural gas have different deliverable dates. This one expires in 1 day. This one expires in 29 days. So if you were to currently be holding a /NG G26 contract, and you were to sell that contract, your profit on that trade would be whatever the difference was between what you paid for it to begin with and what you're selling it at right now. Because, however, there's not a lot of liquidity here in this particular case. Well, there is actually still, because this is still the active contract, but that liquidity is rolling out to the next expiration. That would be your profit in that trade. Now, this is a circumstance where because there's only 1 day to go in this contract, selling this contract and buying this one could present that opportunity to benefit from that calendar spread. That is assuming that the order gets filled and that you could profit from that transaction. That's not a lot of time to go before that contract expires. But there is the potential to create a calendar spread between this 1 day to go till expiration and 29 days to go until expiration. If we were to look at, for instance, the product depth, we come down here to the bottom and we close that up and we take a look at product depth and we look at the futures contract. You can see if we just look at the curves here, and let's take off all of those series. Let's just put on the next few curves here. You can see, let me scroll down here, the steep difference between those two contracts. One of the reasons why is because of a lot of transactions going on. There's a lot of volatility pumped into this particular contract. But that contract could be sold. That contract could be bought to create a calendar spread that could trade that movement from where this contract is to where that contract is. Doesn't have to, and again, because this is 1 day to go until expiration on that NGG contract, that creates a lot of volatility and creates some potential challenges in terms of getting out of that particular trade. All right. So, so Momo says, why do traders only trade futures like oil, gas, soy? There are reasons why some traders only trade some of these products and not equities, because they're speculating on price movement. Maybe they're hedging a portfolio, something like that. Futures contracts tend to be, we've talked a little bit about this, tend to be some differences between going short a futures contract versus other types of instruments. So there are some advantages and challenges both to trading futures contracts. There's no one best solution, right? And yeah, I think, Wiley, that's a good point too, right? Become comfortable with one or two different particular contracts. All right, so let's do this. Let's come back over here to the chart. I've got a couple more. We've got just a minute or two here, but I wanted to take a look at another one here, and this is /DX. So I'm going to go over here to the chart, and we're going to bring up /DX, and this is the dollar futures. And notice what's been going on with dollar futures. As gold and silver have been rising, dollar has been coming off. This has been one of those challenges. The dollar has weakened. That obviously changes trade balances, those types of things. This is subject to things like geopolitical risk, all of those things. If we come over here to this side, so you can see tick size 0.005, so that's our significant digit. Tick value is every time that changes, that's $5. Every time that point changes, that's 1,000. Notional value 96,170. Initial margin on this contract 2170. So not terrible, and it hasn't really moved all that much. We come over here to this side, we take a look at what this move has done, and what I'm going to do is I'm going to add a little space to the downside here, because there's some potential for some downside movement if this breaks that level of support. So, you know, here's the thing. We're kind of on that longer term chart at a support level, a long-term support level back into July. Support down here right around this 96 or so level. Bouncing, and now kind of sitting at that level. The question is, with a product like this, as we're sitting kind of right around this 96, 97 level, does it make sense to go short this contract? Does it make sense if I short this contract to get in at a level of significant support? So this might be an area where, because how much lower, the question is how much lower is it going to go before we start to defend? And how do we defend that? Well, we do things like changing interest rates and those types of things will tend to lift currency rates, dollar value, if you will. So this may be something that we don't necessarily short unless we get a move, a significant percentage move, perhaps below that level. So maybe we come down to this 96, kind of as a big round number, right click, and in this case, sell. And I'm just going to do this as a sell with stop. And I'm going to say, look, if we sell this, because we maybe want to trade this downward direction, we're going to look at getting in this on a sell stop. Okay, so, or excuse me, on a sell limit below. Actually, you know what? Let's do this. Let's do this on a sell stop and not a limit. Let's do a sell stop that says stop, wait, don't get into this trade until it goes below 96. I'll even make it 95.99, and we'll make that good till canceled. But then get out of the trade if it comes back up and it goes against us to 96.55. I'm going to make that 96.55 on the stop, and that's going to be a stop market, and we're going to say good till canceled. So sell it if it goes down below 96, buy it back if it comes back up to 96.50 or 96.55 in this case. So we're going to go ahead and click on confirm and send, read through the order. I'm going to put this in my futures group, and there's my transaction costs, my initial margin in the account or for this trade. I'm going to click on send, and we're going to sell it. So yes, you have to, sorry, Hans, /DX trades on a different exchange. Some futures accounts are not authorized for trading that. You can call the trade desk and talk to them about authorizing your account. There's an additional charge, I believe, to have access to some of those contracts, and I'm not sure all of the different symbols that show up in there. Let's do this really quickly though before we get out of time here. Really quick, let's pop over here. This is where you can find more information about our educational offerings and more information about us as coaches. There's even this great section called Meet the Coaches. If you come right here to the Trader Talks webcast page, this is where you can find all of our webcast archives. Come on over here and type in complex orders, and you've got some great webcasts from Brent and others talking about complex order types, multiple methods to putting those orders in. All we ask is that you click on subscribe when you're over here. And then if you want to learn a little bit more about futures in general, if you're brand new to the product and the idea, come over here to schwab.com/futures to learn more about trading futures products here at Charles Schwab. My thanks to Connie Hill for helping out. My thanks to all of you for being here with us this morning. My thanks, of course, to our production staff and our great reviewers, Nikki and Mindy and everybody else. Thank you very much. We'll see you again very soon. Have a great day, everybody. Take care.